Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your metals market update for this Monday, the 24th of July, 2017, getting on to 2:10 p.m. Central Daylight Time. You know, I love to read the comments that many of you leave for us as you're watching us on YouTube. I don't respond to all of them. I'm just swamped. It's not that I don't want to. I crack up one person saying he doesn't pay attention to copper, he hates copper. Absolutely not the case. Actually, it's a great market to trade if I can catch the trend in it, okay? And I'm talking trend and risk. There's a big part of that. And sometimes because it runs the way that it does, you can't get away from reasonable, what I call reasonable risks. I know you all think I'm a gold bull. Not the truth at all. I'm a trader. I don't even believe that gold belongs in everybody's portfolio. I'm the opposite, so I don't come from that camp either. These, to me, are trading vehicles. My idea of what you do in these markets is basically, you're not buying them to hold on for years if you're trading futures typically. You're buying them to catch a swing. And that's how I look at it. And you've gotten a swing just now, and it might be over in the near term because you're getting overbought. Now, what I was looking for, and I'm going to repeat it again, is I think gold is in a trading range. I think it's caught between roughly $12.95 to $12.05, just giving you raw numbers. The center of that line just happens to be the 18-day average of close. It's just about there. That number is 1253.60. We're 1254.60. On the weekly chart, it took, after you broke down, all of a month to come back up and get up to that price. So the market had a shot here to really break out to the upside, failed, went down, and now it's back to what I'm going to call the neutral territory at this point. When you take a look at an area chart of closes, you don't disagree, do you, that we're in an upthrust. We've gone on a closing basis almost without any break that's been under a previous low from $12.0970 up about $40, $45. When we take a look at the chart action, it is straight up and away, impressive, running into this area right now that it peaked out at before and fell from. I think we're at an area that a correction can happen at any point for no reason at all. The market's got a pattern of higher lows, higher highs. Bullish, unless you come down now and take out 1234.60. Prior to that, it was 1214. So we've had a $20 jump in the pattern. In terms of key action, you've been over the 18-day average, and now you have 2 days in a row where you're over the 100-day average of closes. Now, you might say, well, it has to fall back. It did spend enough time over it here that doesn't have to be the case. It came up, spent a fair amount of time, almost the equal amount under, and now it's back over. This market's looking to figure out what direction it's going to take. What's got me concerned, in part, it's two steps here. You're very close to the upper Bollinger Band, and you're 2 days over that 100-day average. That's a warning sign to me. Number two, you're overbought as can be, and you're nowhere near converting this from being overbought to embedding. You got almost the rest of the week it would take to do that. In addition, you've got to go through the FOMC announcement on Thursday. You got GDP coming out this week. You got a whole host of events taking place. A good part and a bad part. You know, if you look at inflation in Mexico and Brazil, if you get my market letter, you're going to see down. In fact, in Brazil, they're now talking of lowering interest rates 100 basis points over the next year. So suddenly, world inflation slipping back. What is that going to mean for gold? Well, it depends. That could also mean currency values go into a free fall to a degree, and gold starts picking up on other goods. So there's many arguments to it. When I come to the ETF of GLD, it's the same thing. You're overbought, in an uptrend, 2 days over the 100-day average, and failing so far to really punch through and get up to that upper Bollinger Band. In the GDX, today's break low was 21.97, under 22.01. This market has been the leader of the whole gold complex, in my opinion. For this swing, not every swing, for this one. So when the market was embedded, it lost it, it rallied up. It got up to the keys of the 100-day average, just about the upper Bollinger Band, and it slipped back, and it's out of its uptrend because it took out 22.01. It now is a pattern of a higher high and a lower low. Nothing you can do with that. The gold silver, well, it seems at 76.21, that was the break low so far from 78.42, and now we're losing a little bit, silver to the gold. I don't know if silver's got the power to make it up to the upper Bollinger Band, and the 100-day average is way above that yet. But you are overbought in an uptrend. You negate the uptrend if you take out 16.11. Where's the support in the market? It's interesting. It's the 18-day average at 16.12, but because it's so overbought, I don't know if the pros would step in. In the copper market that some of you think I hate, not the case at all. This market has been a son of a gun because it has just been bouncing around overbought condition areas, and when it came down, if you didn't catch this area, which my work would not have caught under any circumstance, I had a lower and low and then a higher high, it never came to an area that made a lot of sense to buy. You're up to a zone now where the market's rich in price compared to where it's been. So the 275 area, an important number. A lot depends on what China does with the growth in its own economy here. Look for that upper Bollinger Band to be a problem in the near term. In the platinum market, you're in an uptrend. Higher lows, higher highs into the upper Bollinger Band. You made a run today to see if you could clear Friday's high, which you did, to reach up to the 100-day average. It did not do it. By the end of the day, it was a very poor close in an overbought condition. The palladium market's at a fascinating position. The market has two plays right in front of it. The first play is it's bearish, lower highs, lower lows, and it's right on its 18-day average. The pros probably are short there. I think they flip to the long side if you get over 847.50, I said that wrong, 847.50, and then they'll put stops under this area, looking to see if it can gain back to the upside. In the meantime, if they buy it, they've got divergence going against them because you haven't turned up the momentum. It's a rough chart right there, but there's two plays. The bears have one going now that they don't want to see 847.5 taken out. The bulls have one where if they can get 847.5 taken out, they'll probably put stops under today's lows and see if they can drive the market to the upside. The dollar index is sick. It just keeps riding the lower Bollinger Band with an embedded reading. I don't know how to say this in any clear English. Until it ends, it doesn't end. This is the most bearish you can make the chart. And until that red line gets back over 20, this market stays down. Could there be profit taking in front of the FOMC meeting that begins tomorrow and ends on Wednesday with a statement from the FOMC? No press meeting this time. Yes, but the market doesn't expect the Fed to do a darn thing except talk in their statement that soon they'll be addressing their swollen balance sheet, if you will, and start shrinking it in, which they've said before. The question that they have and the problem they have on inflation is it's not here. And the economic data coming out since the last FOMC meeting is still not overly bullish. So you look at it all, you look at opportunities, and Modern Trader, a magazine, offers it. Now, if you go on the website to buy it from them, and I invite you to do it, they're great people, $79. Same thing you'll get from us for free. It comes out by email. It breaks the columns into trades, techniques and tactics, after the bell, and the different departments. Plenty of news stories. It doesn't matter if you're a derivatives trader, an FX trader, a futures trader, a securities trader, somebody buying options on stocks and or commodities or writers of them. These articles are tailored for those type of traders. And they're written in a way for you to understand. You know, as I said in one of my other videos just about 20 minutes ago now, I said that, I'm in a building full of brilliant nerds, and that's what's taken over futures for a lot of these quantitative guys. The problem is I don't talk their language. I don't know how many of you do. This magazine talks their language to you and interprets it in ways you can understand what they're doing, and I think that makes all the sense in the world. Plus, it breaks down different trading ideas, and there's new ones coming out of this magazine all the time. So how do you get this? As I said, it's free, and it comes with a daily market focus, short-term stories written by their analysts. And they don't work for them. These are different market analysts all over. How do you get it? Call us. You can go to our website. You'll see a carousel of free offers. You can click right up here. If you do so on YouTube, you'll see an icon up here. Click on it. The form will appear to fill everything out. Or underneath us on many websites, it says, click here for Ira's free offerings, and boom, away you go. I'm Ira Epstein. I thank you for watching, and you have a good day.